Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Obviously, as you get more intricate, as your strategies get more complex, probably greater risk with probably greater reward. Wouldn't you say that, Dan?
Yeah, I would say that with any strategy, really, that is the trade-off that you just can't get away from. It's always, if you're looking for more reward, you're always going to have to take more risk. But, one thing that separates good option traders from, less good option traders is to kind of be able to intellectualize that a little bit. And though I know if I want a bigger reward, I have to take more risk, constructing a position where I take maybe just a little bit more risk to get a lot of bit more reward, that ends up being a winning recipe.
Oh, that's great. Great point, Dan. Alka has a question. He says, when do you use the strategy? Do you do it personally? Bullish, bearish, neutral? Do you have a preference, or do you just, basically, you can use it at any point?
Well, it is a versatile strategy. I kind of laid this out as if there's two choices, but really there's a lot more than two choices. For those of you who are income traders and maybe have bought calendars before, you know that the place to be at expiration is right at the shared strike price, right? Well, if right now the underlying currency is at the strike price, well, great. That's a neutral strategy. I want the currency to not move between now and expiration. But if I'm maybe a little bit bullish, what I could do is I could buy one of these calendar spreads with a strike price that's higher than where the currency is trading right now. And so there, the same rule applies, that I want the currency to be at the strike price at expiration, but now the strike price, because it's higher, the currency has to move up a little bit. So I actually end up with a bullish strategy. And if I were to look at the Greeks, to net those out, I could see that it's bullish because it would end up having a little bit of a positive delta. And I could do the same thing if I'm bearish as well. I could select a strike price that's a little bit below where it's trading. And, because you have that negative delta, if the currency falls and you end up kind of timing it right and it goes to the strike price, you can get a fairly good leveraged profit when that works out.
Just want to remind everyone, too, that one thing that Dan's going to offer that, maybe a lot of us don't have. I've known Dan for a number of years, but Dan's going to understand their specific markets, and there are nuances, as Dan said, to each market. If you're trading oil, that's going to be completely different than if you're trading, let's say, SPY. If you're trading U.S. dollar versus Australian dollar, that might be completely different than trading Google. And when I'm saying different, the skews are going to be different. The volatility skews might be much different in one versus another. You're going to want to understand, there's no perfect recipe here because the correlations can break down, but you want to understand the normal relationships so that you could set up your trade based on your own forecast and then your own prediction of skew. Wouldn't you say that, Dan?
Yeah, for sure. It is, although on the one hand, options is options, it's gamma, theta, vega means the same thing no matter what you're trading. Yeah, these volatility nuances in terms of skew are really important. So you ought to spend a little bit of time kind of taking a look at that and getting used to it before jumping in.
Hey, Dan, can you explain your book, and go into it? Because I'm getting a lot of questions on, then I just typed in the name of the book, Trading Options Greeks. What did it go into, and where can all the attendees get it?
Sure. It's a book written for people who maybe are new to options or people who've been trading them for years. I've had some professional traders pick up my book and tell me that they learned a ton, and I've had some people who are, really new to options, and they learned a ton. I kind of start out slow, start out at the beginning, but by the end I ramp up and I talk about, like market maker positions and delta neutral trading. So it's pretty comprehensive. my editor wanted it to be a certain length, but I wrote it a little bit longer because I wanted to make sure I got in everything that I thought was necessary. And I mean, you can get it on Amazon, or you can contact me, and I'd be happy to send it to you as well.
Okay, that's another great way. Andrew has a great sense of humor. Dan, I hope you don't mind it. He said, since Vega is not actually a Greek letter, how can you cover Vega trades in your book?
That is a good point.
Touche, Andrew. Good point. I teach, as you know, at the OIC, and I do that all the time. Talk about the option Greeks, and we know that the Vega is not a Greek, but we throw it in there anyway. So that's just part of the option Greeks, if you will. So you're right. But you know what? Vega is really important. In fact, Dan, this year Vega was probably the most important Greek, although the next month or the next couple months we might say that something else might be the most important Greek. And I just gave some volatility seminars for the OIC, and I always get which one is the most important Greek. And my answer is it depends. I don't know. What's your take on that?
Yeah, that's absolutely the best answer. I mean, a lot of times Delta can be.
Right. Exactly.
But I'll tell you, I mean, kind of the classic example, I mean, you've probably talked about this in your seminars. I mean, the classic example is buying, for example, a call before a big event is expected. For stocks, it could be earnings, A lot of people buy calls, and the stock goes higher upon earnings, and their call goes down, And in that case, it ends up that Vega was much more important than Delta. And if you're buying some of these short-term options, theta could be way more important than delta. So yeah, it depends on the strategy. It depends on what's going on in the markets. Depends on a lot.
Couldn't agree more. I always think that what differentiates a good trader, an average trader, and a poor trader is the poor trader has no idea how much money they're going to lose when the strategy isn't working, and the good trader knows right when they put the trade on what would cause the trade to turn bad and sort of reacts faster. What do you think, Dan?
You know what? That I spend probably the first session or two with every single student I have, whether they're new or experienced, hitting home on that point exactly. That's it's not about being able to predict the future, like I said before. It's about managing your risk, and if you don't know what your risk is, you can't manage it.
That's a good point. Guys, type in any other questions regarding anything with options, since Dan has written a book on Greek. So if you want to go to Greeks, that's fine. You want to talk more about calendar spreads, that's great. Dan has a business, markettaker.com. And you can get them there, Dan at Market Taker, or obviously it's Market Taker, www.markettaker.com. You can check out his services. You could also mention that you were here at the ISC, and he'll I guess he'll spend a little bit of time with you to see if you would meet each other's sort of needs, as far as what you're looking for and what he's looking for in a student. So please contact Dan if you're interested, and type in any other questions. Give everybody another moment or two. And Dan, you working on another book? Where's your focus these days?
I talked a little bit with my publisher about that, but I got to tell you, right now I'm so busy with Market Taker mentoring that I don't know when I'm going to be able to do it.
Understood. I mean, I know that it's challenging because you got to stay abreast of the markets, and when could you really write? But maybe on Saturday and Sunday, right? I mean, too much. It's hard to write during the week when the markets are open.
Oh yeah, it sure is. And I mean, in addition to working with students, which is often during market hours, but I'll work with students at night for because there's a lot of students who have full-time jobs, and it's just much more convenient for them. But I mean, I have a subscription webinar series once a week. That takes up some time, and I do a lot of talking to traders. So yeah, it's a tight schedule.
Thank you for participating in this week's session. Please join us again next week. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts.